Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference. And I'm here with Greg King, who's the CEO of RexShares. Greg, great seeing you.
Good to be here.
Your firm has some unique ETFs, but one in particular is all the benefits of being long equities, but also the component of gold put there in as well in order to help diversify the portfolio. Talk about the idea behind this.
Sure, that came from talking to clients about gold. When should you buy gold? When should you take it out of the portfolio? How long should you have it in? And our view is that if you look at the diversification of gold and negative correlations right now, sometimes a little bit positive, but generally pretty uncorrelated to equities, you want to have some gold in there for the long term. And so how can we do that in a capital efficient way? So our fund, the ticker's GHS, takes S&P 500 stocks and overlays gold via futures. So basically you have $1 that's doing the work of $2 in the portfolio. And what that does is it puts a discipline around the concept of when do I have gold. You sort of have a permanent position in gold, but it's done in a capital effective way where you don't have to take down your equity exposure long term.
So as advisors, we all know the value of diversification, the value of having gold in there, but we also know, just by looking at asset flow, that as advisors and individual investors, we do a terrible job of implementing that diversification. We tend to buy gold after it's already had some type of a run, and we tend to sell it after it's kind of fallen off a little bit. So what this does, as you mentioned, is give that discipline where you're 100% long equities, but on top of that, through certain strategies, you're able to add another 10% allocation of gold, is that right?
It's actually 100%, so, and you're exactly right. We can be our own worst enemies, right, in terms of buying high and selling low. So if you take a step back and remind ourselves, like, what's a future, right? A future, to get exposure to the movement in a price, you can get long a futures contract, but you need some collateral to support that position. We use the S&P 500 stocks to support that. So we get 100% exposure to S&P 500 stocks, but also 100% exposure to gold. So you have, for example, if they were both up 10%, the fund would be up 20%, right? It goes to the downside as well.
Sure.
But on a long-term basis, gold is obviously up 8% a year for 40 plus years. We all know what the S&P 500's done. And so in the short term, you have a negative or sometimes a little bit positive correlation, but pretty much zero. But on a long-term basis, you have both asset classes going up.
So for example, if you have a high correlation, the S&P 500 in your portfolio, but want to add gold, but don't want to sell your S&P allocation, all you do is replace it with this, and you've got both.
Exactly right. That's the idea, and it's to make life easier for people who want to diversify, but don't trust themselves to be market timers or tacticians, knowing kind of when to get in and when to get out.
Okay. Before I let you go, we haven't had a lot of volatility, and last year you have an inverse volatility ETF that was up 81%.
We do. We put out VMIN, VMIN. It's the first ETF, so 40 Act ETF with a fiduciary, a manager who's looking after a short volatility position. That can be very risky, but just a little bit of that in portfolios, especially after the VIX will spike, is what a lot of people are looking at for a buy the dip type of strategy. And we did have a very good year last year.
So if you feel there's going to continue to be less volatility, something to think about.
Or after volatility spikes and you feel it's going to come back down again.
Excellent.
Thanks, Tom.
Great seeing you, Greg.
Good to
Thank
see
you.
All right.